सो स्टार्ट कर सकते हैं ना?
यस सर, स्टार्ट कर सकते हैं सर।
वेल, गुड मॉर्निंग एवरीवन. Hi, this is Ankit here. So I guess we'll wait for a couple of minutes more before a few of the participants could join in this webinar, and then let's start with our session. Just making it clear beforehand. So probably it's around 10:59. Let's start the session by 11 or 11:01. Yeah, so it's 11 o'clock. So let's begin the session. So before beginning the session, I would like to give a short introduction about myself and probably on the projects which I'm associated with right now. So, I'm Ankit Baid. I'm an MBA Finance. And my previous experience has been that I've worked for 6 years managing portfolios, a wealth of HNIs and ultra HNIs, advising them on the current landscapes, the future trajectories, the opportunities available for them, to basically invest their surplus, and also helping them plan out their future roadmap. So this is a short introduction about myself, and the project which currently I'm associated with is that I'm working with Affluence Advisors. So we basically are an consulting firm. So we solve pressing business problems, ranging from strategic advisory. If I have to name a few, that if there's a client who wants to set up a business or maybe wants to tap a new market opportunity or a new product, we advise the client on the trajectory of what is to be done, how is to be done, what should be the pricing, the competitor analysis. So advisory is a major forte. A second offering is like we also help startups raise capital. Uh, uh, being a part of their journey or roadmap towards listing. We also help startups list on exchanges. So startup advisory is another offering, and we have a forte on in compliance, tax-driven tax-driven legalities, and offering A to Z business requirements. So this is all about affluence. And now starting with the presentation. So yes, the changing landscape. We are in the new world right now. So the reason I have mentioned this, given a name to this PPT as changing landscape and new world will be known at the end of the PPT. So let's discuss on the current landscape. 2024 is basically a magical year. We have 80 countries getting into elections. With the first half right now, where few countries have already contested, and India is right now under the process of elections. And second half would be dominated by South Africa, European Union. You'll see UK coming. You'll see US coming at the year end. So let's talk on India. We basically are seeing jitters around. So when it comes to elections, so we have seen VIX, which has scaled up from 10 points to 22 points right now, a massive 100% rally. So that's very much visible just because there's a lot of uncertainty in Indian markets. Yes, on the first point, when you see retailers go into the Satta Bazaar to understand what is the political wind, which side the political wind is, flowing towards. Will the BJP get a strong mandate of what is promised of 400, 450 plus, or will they lag behind around 280, 290, 300, which would create uncertainties in the market? So that's the reason you see VIX is shooting up. Retail investors are going to the Satta Bazaar and understanding where are the bets being placed. so that they could structure their positions accordingly. And third thing is that if you see F holdings, right? So FI holdings are at two extremes. So the first extreme is on the short end. We have 3.9 lakh contracts short, which is the highest ever. And you have on the long addition of 2.4 contracts on the on the long side. So they are also uncertain, and they are balancing up the portfolio on the long side and the long end and the short end. The recent rally, which was driven day before yesterday, if I have to tell you, when the markets were up by 300 points, it was not because of the short covering, but it was because of mainly a long additions by FIIs. So this is the market trajectory. Let's talk on the Indian economy as well, or maybe the whole of Asia. So the Asian economy, you see Japan, you see China, and you see India. Japan has shown an outperformance very lately. You see China has shown an underperformance. You see India has shown neutral to underperformance. You see North of Asia, China has basically underperformed for only sole reason because of outperformance by India. Okay, so if I have to tell you in a very simplistic way, from year 2000 to 2020, you plot MSCI China and MSCI India in dollar terms, you would see the movement in locksteps. So they have always moved together. The divergence has happened in 2021 when China economy had underperformed and the Indian economy had outperformed. So that divergence right now is receding. You see the Indian economy, where I told you in the first commentary that it is performing neutral to underperformance. Chinese economy right now is getting a bit of traction. Right now, you see FI monies are being flowed into China. That's one point. Just because the entire economy or entire markets are overly pessimistic than it should be. Hong Kong is trading at 8 price earning multiple versus their long-term average of 10. China is trading lower than their long-term average multiples. So that's one enticing factor that FIs are moving to China. Second factor, if I have to highlight that, you see a lot of stocks in China having a dividend yield of 4 to 6%. Come on, then definitely the money is moving there. Just because in terms of India markets have always commanded valuation, premium valuation. So if I have to talk in numbers, premium valuation when compared to Asia ex Japan, we were at a peak of 80%. Right now we have, deflated down to, 40, 45, 50%, but still we are above the long-term average. So we have always commanded premium as an economy. But if you see that when we see that India's valuation trajectory is not overvalued, it's fairly highly valued when compared to the long-term averages. If I have to tell you Sensex since last 6-7 months, it has moved from 72,000 to 75,000. It's a rally of 4.5 points. Okay, not much. It's trading at a very narrow range. So अगर सेंसेक्स यही नारो रेंज में ट्रेड करता आएगा नेक्स्ट क्वार्टर तक, you will see the price to earnings falling by 3 to 4%, P falling by 3 to 4%, bringing down the valuation by 8 to 9%. So thereby you will see the markets being attractive then. But for time being, that's the reason the money is being flowed to China. Indian markets are very uncertain right now, and a clarity on policy, a clarity on election mandate is expected by FIs because they don't like to take risks. They'll enter at a higher rate, but not at the riskier levels. Okay. So then, coming to the second point, you see what I feel that the second half of the rally or second half of the movements would be driven by the US mandate. If at all there's a loss of incumbent, could drive sustainable changes in trade policy, foreign policy, regulation, and fiscal and tax policy as mentioned in the PPT. So that would create fresh round of issues and uncertainties and relations amongst the global economy. So that's very much taken into consideration at the second half of the market rallies globally as well as locally. The third point, what we feel is that there would be trade wars happening. First set of tariffs were being raised against China by US in semiconductors, in electric vehicles, and in solar products, right? But it is not of much effect to China because it constitutes basically 0.1% of their exports to US. But there would be tariffs. You will see European Union, you will see US grouping together and waging a war against China in terms of tariff, because one reason is very much peculiar of oversupply, overcapacity. So all we all remember 2003 and 2004 when Chinese economy influxed the global system with metals, and that led to fall in the metal prices as well as affecting major economies, and US specifically led to a loss of 2.3 million jobs. So US knows that, then they have faced this overcapacity issues already against China. So they're taking their stand, and trade wars would also guide the markets at the second half of the year, probably next year as well. Last week we definitely saw influx of data, including CPI from India. There was a Fed commentary. There were retail sales from US. You had seen CPI figures from Europe. Euro region CPI figures were very positive. So was CPI figures from India and US. But talking on two perspective about India and US, we basically see core inflation falling, but there's an always uncertainty stating of one point. Is the demand getting hit because of high interest rates, or would it lead to deflationary point? So that's an area of concern. And second point is that if at all the monsoon doesn't support us, we'll see spike in food prices, which is leading the inflation right now. So that is also taken into consideration and should be taken into consideration. US CPI, the market was sharing with the US CPI numbers because it was closing out the gap among between the Fed's target. But I would also highlight one aspect, that if you see the PPI, the Producers Price Index, which is the first a touch of inflation which flows to WPI and CPI, the Producer Price Index had risen in the month of April, and that's an area of concern which affects the PC, the personal consumption expenditure, which the US Fed tracks very closely to plot their interest rates. So this is the current landscape. And getting to the next slide, which is the main part of our PPT, is will the history repeat itself 1940s? So what does this mean, and why are we talking about this, and why are we talking about US? So if I have to tell you one specific aspect, that US will be the center of our conversation, because whatever happens in US affects the economy, because it is the world reserve, right? So उधर जो भी होगा, definitely it will create jitters across the economy, across the global systems. So coming to the point, if you see in the era of 1930s, and I'm placing the cursor as well for your understanding. If you see the era of 1930s, the US GDP was at basically, if I have to tell you, 120%, yes, which was brought down all the way 30% in the next 15-20 years. And going down ahead, the blue line, the interest rate, and the red line indicates the money supply. Okay. So I'll tell you one thing, that the interest rates were, kept close to zero level, dirt cheap level, and there was an influx of money supply. And this instance, the very instance which I'm talking about, had just occurred once until now in the era of 2010. When the US GDP was at 160%, it was brought all the way down across the decade by 30%. And looking down, you would see that the interest rates were at dirt cheap level 0%, and there was influx of money supply. So at these two instances, how did US manage to bring down the debt to GDP levels? Given that the US debt to GDP levels is right now at 125%, which is very much mimicking the scenario in 1930s and 2010s. Okay, so I would help you understand that how did US manage to get down its debt to GDP levels in the two instances, specifically 1930s to 1940, 1950 ranges. So I would want you to have a look across this years 1930, 1940, 1950, when interest rates were basically kept at 0%. Okay, so going across the next slide. So this is basically the inflation numbers, and this is the treasury high inflation. They rise their interest rates to curb the inflation, right? So that's a very basic understanding, and it has been followed across all the economies. But the thing with US was different. Getting back to the previous slide, if I have to tell you that during this era, the interest rates were kept close to zero, and there was influx of money supply, right? So despite high inflation, the interest rates were kept close to zero, and there was influx of money supply. So now connecting the dots, due to this, the US was able to post a good nominal GDP growth. The first point. The second point is that because of low interest rates, they were able to service that debt at lower cost. So there was influx of money supply in the system. So these are the major triggers, which I feel that 2024 is where US is repeating the 1940s playbook, that we are at 125% GDP, debt to GDP. We have also seen interest inflation spiking at 8 to 9% in the given instance in 2022-23. Right now, though, inflation has receded back to close to 3.5%, but we will talk about inflation in the next coming slides. But I'm just giving you an highlight that US is playing the 1940s playbook, where they are planning to bring down the debt to GDP level by adopting what they did in 1940s, by influx of money supply. The nominal GDP is doing really good. Okay, and the interest rates are one major concern which will be brought down. So I would connect all the dots in the next specific slide. Is the money supply when we see 1930s to 1950s huge? Is it huge even at right now at this current state? So let's get back to the next slide. So this is the gross issuance of US Treasury, which is a quarterly gross issuance. These two years would be the center of our conversation in this PPT. In year 2020, you would see US basically supplying, printing huge amount of monies, right? Huge amount of monies. Hello? Yeah. So you would see US printing huge amount of monies in 2020, because it's very much evident because it was a period of Corona. It was a one-off event where none of the economies were, experienced how to handle this event. So they had to support the economy. They had to support the people. They have a huge Medicare cost associated. So that's one specific aspect which I believe that US did, print money, huge amount of money in 2020-20s. But what is the necessity of US printing the same amount of money in 2023 and 24? Because I guess we are at a Goldilocks kind of situation where we see that our nominal GDP is doing really good. We see our inflation is also under control. We see a strong labor market. Okay, right. We see a good retail sales number as well. So, what is the necessity of US, printing so much of money? So that's one area of concern or point. Ki, if at all US gets into recession, then it's going to print more money than what it had printed in 2020, right? So let's understand ki two reasons ki why is US printing so much of money and the effects of printing so much of money. So I guess this is a no-brainer slide. Anyone could understand, even if I didn't have an annotation. This is something which is going up, and this is nothing but the US interest payment on the federal debt. So we are at projection of $1 trillion of interest payment on our debt, which is about to rise to $12.4 trillion in the next 10 years. So that's a huge amount of money, right? So US will definitely try to rub off this interest rate off their shoulders by reducing the interest rates. So getting back to the point where I connected on the first instance, that is US playing the 1940s playbook, where you see a good nominal GDP growth rate, right? You have a good debt to GDP ratio. You have influx of money supply, and you have high interest rates. So if you notice on all these instances, our debt to GDP ratio is at 125%, versus in 1940 it was at 120%. Our money supply is at all-time high, versus it was at all-time high in 1940s. We have a good nominal GDP being reported, which is a good nominal GDP being reported in 1940s due to industrialization. And interest rates were the major concern, where interest rates were kept at dirt cheap level. Right now, interest rates are at 5.25, 5.5, which will be brought down, definitely. So you would see an era where US will be facing high inflation. US will have high amount of money supply, but the interest rates would be kept low. So this is not an area of concern. This would be become the new normal for the economy. So I guess that period is sooner than what we think. So we'll see interest rates receding despite inflation hitting highs again. So if I have to tell you why would inflation hit highs, okay, so US has a lot of cost. So there's a cost to Medicare, there's a cost to remilitarization, the cost to reindustrialization, the cost to reshoring of factories, there's a cost to establishing a green technology. So with so much of cost leads to high expenses, right? So with high expenses, when your expenses are high and when your income is less, you tend to default. So would you think US would default? So I would pause for 10 seconds just for you to think about given this scenario where if I've mentioned right now that these are the parameters, would US default where your cost, your expenses are high, your income is less, would US default? So answering to the question, no, definitely not. US has an magic machine. US prints money, right? So US के पास एक machine है जो पैसा print करता है. So the supply of dollars will touch the roof. Okay. So whenever a supply of something is excessive, the value tends to fall. So that's a basic economic concept. So that's the reason you see that the real assets tend to performing really good. I would name a few, which would be gold. Gold is doing really good. I would name a few silver. Silver is doing really good. I would name a few blue chip companies. Those are doing really good. Real estate, that's doing really good. So at given this scenario, when the value of money falls, because US has always been an exporter of dollars. Okay, so and they really need money, to suck in all this cost, which I mentioned: cost to remilitarization, cost to industrialization, cost of Medicare, cost of establishing green tech, and whatnot. So that's one thing. Talking on inflation, as I mentioned, that inflation would definitely shoot back, and one should not get surprised seeing inflation again hitting 5%, 6%. Interest rates will definitely recede down, and money supply would hit up because US needs money. And talking about real assets, when I told you at this situation, real assets tend to perform really good. Talking on gold, let's get to the next slide and see what's happening in the gold market. So major economies. So basically, there are two ways where US could shy away from their interest payments. One is either by reducing their interest rates and deflating their interest payments, and second thing is that taking off those debt and letting the other economies buy their debt. So those are US treasuries, right? So I'll show you one instance where 2002 and until 2012, 2014, China has always been a major buyer of US treasuries. But after 2014, you see, there's not much buying happened. So after 2022, you see there was a major selling from $1 trillion dollars of US treasury, and right now it's at 800. Right now, China had recently sold 30-40 billion dollars of US treasury. They are sitting at close to 760 billion dollars of US treasury. So where they were at 1.2 trillion dollars, they're at 760 billion dollars. A huge selling of US treasury happening. One main reason is after 2022, when US had showed his true faces, when it had confiscated Russian reserves in dollars. So that's indirectly telling ki, boss, we want you to invest in US, but we will tell you what will be the value of that dollar you invest. So China was very clear that, boss, we'll have to sell our forex reserves in US Treasury as much as we can. And with that money, what were the other economies also doing? You see, Japan was also following the trend. Japan was sitting at $3 trillion dollars of US Treasury, right now at 2 trillion. They have sold $1 trillion dollars of US Treasury. So this money basically is getting into gold. So gold is getting a status of reserve currency right now back, which it had in 1940s to 1960s, 70s. There's a concept called above ground theory. So what is above ground theory is that US has been dominating the prices of gold since last couple number of decades. So if I tell you that if US buys and the UK sells, the gold price goes up. And if US sells and UK buys, the gold price goes down. So US has always been controlling the gold price. But seeing this chart where US has been offloading their gold and still the gold prices are going up just because China, Japan, and major economies are offloading the US treasuries and they are buying gold. They are going berserk in gold. China, if I have to tell you in numbers, China has bought 734 tons of gold, which is 23% up when compared to the last year 2022. In 2023-24, they had bought 734 tons, and this calendar year they have already bought 300 tons of gold. So yeah, it's very much visible that gold is gaining the traction of reserve currency, and people no more are believing that there's a saying that US is one of the safest instrument. Yes, it is the safest instruments, I agree, because they don't tend to default because they tend to print more money. If you print more money, if the dollar supply is higher, the value of money indirectly falls and they're not ready to take that risk, so they are getting back to the gold. And because gold is limited, आप डॉलर्स को कितना चाहे प्रिंट कर सकते हो, बट गोल्ड assets are always limited. So that's the reason assets will move in this scenario. You see gold doing really good. You will see silver, which is doing really good right now, though it has industrial uses, but you will see silver doing really good. It would hit 1 lakh. I guess it's trading at 92,000. So 1 lakh trajectory is very close than what we expect. As I told you, real estates are doing really good. Blue chips are doing really good. So the value of money will fall, the value of real assets will go up. So these are the countries which are actively buying gold: Turkey, China, India, Kazakhstan, Czech Republic, Oman, Singapore, Qatar, Japan, Poland. So that's one basic demand of gold, and that's the reason the gold prices are shooting. Despite there's a saying that whenever the interest rates are up, the gold prices are always down. No, but this time the interest rates are up, the gold prices are also up. So that's a different kind of economic landscapes changes which we are seeing. So uh, noting the last point where I've told you gold has been priced for its scarcity and intrinsic value, right? So again, coming back to the question where I would tell you that why is US printing so much of money? What's the purpose that it is printing so much of money? As I told you, it has a lot of cost associated. But are those costs really paying off US at the later stages in future? Let's see. So this is a playbook where this is a US China trade war since 1980s to 2000. Who dominated the global trade? You see, US was dominating the global trade for a couple of decades, and until 2014, where the trend has shifted to China's favor. Okay, so you could also see this. I'll repeat it for you so that you have a brief idea about what's happening in the global landscape. So these are blues. Blues are where the US was dominating the global trading landscape, and reds are where China has taken over from you. So it was in 1960s where US was trading in kind of hub and spoke model. So US had its trading partner affiliated with various countries. So this was the scenario before, and this is the scenario right now post, where China is dominating the global trade. So US is definitely fearing right now. There are two instances because they already lost the price control of gold. They are losing the trade war against China because China has always been an exporter to US and US always been importer. That's the reason there's a huge trade deficit, and you see the change in the global trading landscape. So this was US partnered with Germany, partnered with rest of the countries, kind of hub and spoke model, right? So right now you see China dominating the trading landscape. Okay, so highlighting one more data in 2010s. China used to settle their trade in their own local currency. It was zero. Right now, they are settling their trade at this current juncture is 50% in the local currency. So they have moving away from dollars as well. So the demand for dollar is also tend to be falling in the global trade scenario where dollar used to dominate the global trade. You see China having trading partners centric towards them, where the economic landscape had totally shifted in favor of China. And China has always been a manufacturing economy. So that's the reason US always fear the overcapacity influx of supply to the global system, which China has always done. And if US tends to lose the dollar dominance and US tends to lose the trade war, US has already lost the control of gold prices. The dominance of US deteriorates at the end of the day, right? So US is fearing all this. So that's the reason US are going berserk, printing money. There's a lot of reshoring happening. The facilities which were spread across the globe are being shifted to the US. If you see the construction spend in US, one third is accounted by factories. So US are going berserk in developing factories, developing green tech cities, solar, EVs, because they know if they don't do it right now, they're losing the war against China and they will lose the dollar dominance. Okay, so whenever we talk on manufacturing, yes, we are going to talk about India as well. So I guess this slide is very clear that the reason US is fearing China, and the reason US is, playing a 1940s playbook where their nominal GDP growth is really good. You see the interest rates would definitely be brought down close to zero, despite inflation hitting highs again. So these are the 2-3 instances which I feel that, yeah, they are mimicking the 1940s playbook. There was an influx of money supply as well. So getting back to the Indian slide and talking about India, we see that the policies are, closely shifting from demand side to supply side. So earlier the government was very much focused in, prompting the demand by tax cuts or maybe coming up with subsidies which boost the consumptions. So it was a consumption driven economy, kind of. But right now US is shifting to the as in India is shifting to the supply side, where governments have come out with policies supporting businesses, coming out with PLIs, setting up a manufacturing ecosystem in India, because we know that manufacturing is the only driving force behind every emerging economies. So I would want you to go across this table for a couple of seconds, and I would highlight you about. I would highlight about this maybe after 10 seconds, taking a short break. Yeah. So you see, Thailand, the leap period was around 1985, 1991. And during the leap period, their average GDP growth rate was around 9.3%. So the manufacturing share before the leap period was around 21.9%. And at the end of the leap period, at the end of their manufacturing phase, it at 28.2%. So it's a total shift. The 29% of the growth has been driven by manufacturing. China has always been a major beneficiary. 1980s to 2000, the growth was 9.8%, excellent growth rate. The manufacturing share was at 9.1%, which all the way grew to 32%, 252% growth, right? Indonesia, Vietnam has also seen the same kind of growth. So I guess Vietnam is a proxy to China. Vietnam will gain a bit of traction. You will see a lot of manufacturing bases being shifted, because economies will go against China, and those countries which have the manufacturing bases shift in China would shift to either Vietnam. If not Vietnam, then India. So India will replace those industries which are vacated by China. So India would definitely compete with China, but China is always way ahead than what we think. So in 2023, you see our manufacturing share at the start of the phase is 15.2%. So where do we see our manufacturing share at the end of the phase? Or probably let's talk about it. So if I have to tell you what different did China do, and where did we lack? So get back to 1980s. Okay, so 1980s was the time where China had liberalized, and 1990s was the time where the Indian economy had opened up, liberalized. Okay, so it's a gap of 10 years. A gap of 10 years definitely can't cost you, where India is at $3.54 trillion economy and China is at $18-19 trillion economy. It's not going to cost you 10 years because of this. There are a lot of things happening. So that one specific thing is that India have never invested much in human capital. Okay, so I would tell you, 90s, 1970s, the per person income in India was at $86, versus China's $82. We were ahead of China. and South Korea was at $92. Okay, so this was a period of 1960s to 1980s. And coming back to the current landscape, India's per person income is at $2,500, which is China's $12,500, and South Korea's $36,000. Okay, so one very instance is that we as an economy have always lagged behind investing in human capital, because the time China had opened up, liberalized, they had an excellent, workforce which were pretty much skilled, which were productive enough. So that's the reason, China is what it is right now, because they started at the right time, right moment, with right workforce, with right aspect to everything. And that's the reason you see China dominating the manufacturing landscape, and you see their $18 trillion economy, and you see the share of their GDP growing from 9.1% to 32%. So India will have to also invest in skilling our labors, definitely, because if we are focusing very much into manufacturing, then we'll have to, drive policies which, upskill our workforce as well. So these are our assumptions. If we expect the nominal GDP, which for the financial year 24 is $3.42 trillion, and for the financial year 30 estimated $7 trillion. So it's a growth of 2.05x. Okay, so the manufacturing GDP right now is at $453 billion. And if we see this figure achieving, we'll have to see the manufacturing grow 3 times, from $453 billion to $1.35 trillion. Our exports has to grow 3 times to $2.32 trillion. Our merchandise exports has to grow 2.5 times to $1.132 trillion. And overall capex is something, I guess, 2.2 times is also a very, not a very optimistic number. I would tell you why, but we'll see our capex also driving growth, growing from 1 trillion to $2.376 trillion. Okay, so what we feel is that at the end of the manufacturing phase, we could see that India's share in the GDP would increase from 15.2 to 20%. This is a very rational, this is a very fair amount of calculation being done, taking out the average, and being below the average, so that being very conservative at 32%. We might see super growth periods as well. You might see periods where there is stagnant growth, but 20% is what we expect the manufacturing share, to pick up in the current GDP growth. So India's decade, is it? So it's very clear that manufacturing creates 5 times of more job than services, right? It is very much, because it's a very circular economy. If me as a government, brings out any orders and enters that orders to the private players or public players, the capacity increases. They onboard a lot of people, more and more amount of people, and they'll place orders which they will onboard more and more amount of people. So manufacturing definitely creates 5 times more job than services. The only thing what we did in early 2000 was we shifted our focus to services. So we had early investments in digital public infrastructure, which allowed India to leapfrog manufacturing to services. So when that has happened, it creates a K-shaped economy, because you see services as in economy. You see companies being placed at tier 1 locations. So whenever there's a pickup happening, you will see tier 2, tier 3 lagging behind and tier 1 picking up. That's the reason you see there's a K-shaped recovery always. That's because of services. So if the case was manufacturing, we'll see a stable amount of recovery happening with tier 1 and tier 2, tier 3 are all growing together. So manufacturing growth is very much required in India to bring a stable growth across the region's economy. And I would say the government policies are very much focused on establishing and creating manufacturing ecosystem. You would see PLIs on electronics. You will see PLIs on laptops. You're seeing PLIs on semiconductors. You're seeing PLIs on automobiles. There are a lot of the PLIs which will be coming out later stages. We'll have to track the full year budget, where the government are focusing on bringing out new policies or new PLIs, or maybe strengthening their existing PLIs. So there is an opportunity plus capacity plus favorable environment. So, I won't go very optimistic because we have always been overly optimistic on India. But in terms of opportunity, I would highlight you a certain number. It was during 1980s, the percentage of working population in India, working age population in India grew by 2.5%. Okay, year on year. 20 years before from now, it grew at 2.1%. 10 years before from now, it grew at 1.9%. Right now, it's growing at 1.5%. The percentage of working age population, in our economy. And next 10 years, it's going to grow at 0.6%. And I guess 0.6% is a very a pessimistic figure which we are seeing, because unless and until government creates jobs, majorly jobs which are very much focused to manufacturing point, not the services point, we will see the percentage of working age population fall. And if percentage of working age population falls in an economy, you will see the growth decelerating than accelerating, and it could cost you 1 to 1.5% of the entire GDP growth for the next 25 years. So it's a huge number. We are also seeing that government has been very, very supportive in terms of establishing manufacturing ecosystem. If I have to tell you one specific aspect, that Apple. So Apple had employed 1 lakh, 1 to 2 lakh people in India. So they are very optimistic in scaling the production percentage share in India with respect to global to 14 to 15% of the entire global production, which is centered to India. So they'll try onboarding or hiring 5 lakh more people. So there would be a stagnancy in service exports and service job creation, and you would see blue collar manufacturing production exports rising and job opportunities developing over there. Government is doing every possible thing, to create jobs. Of 1.5 crore jobs which governments will create for the next 10 years, 1 crore jobs should be very much focused to manufacturing, because that is very much required for us to reap the benefit of demographic dividend. And if we don't create such jobs, I guess whatever story, whatever optimism we are talking about is all magic. So that's what. So another point I would tell you that according to Jeffries, 7.8% of the global growth will come from India, versus less than 2% of global capital invested in India. So yeah, that's a gap. So if I expect a certain amount of global growth coming to India, you will see certain amount of foreign influx capital entering India. You'll see huge FDIs happening. You will see rupee again strengthening. Again, as I told you, dollar influx of dollar, the money leads to fall in value of that specific currency. So there are ecosystem which is supporting India and India's growth, but there are few aspects which I mentioned you, as the percentage of working age population has to increase for us to reap the benefit of demographic dividend. And there's one aspect which I mentioned, that the capital expenditure is growing 2 times at 2.53 trillion dollars. So I'll tell you, China's investment is 42% of its GDP. So $7 trillion invested in manufacturing, invested in infrastructure, invested in real estate and nuclear energy, which is $1 trillion of ours. So that's one thing, that's the reason China is always way ahead than what we think. Not only against us, against US, or with respect to the global economy and landscape. So China has always been at the forefront, forward-looking, thinking about what's going to happen 5 to 10 years down the lane. Why? That's the reason I mentioned nuclear energy. When I told China has capacities to develop, because nuclear energy is one of the cleanest form of energy right now. So if at all, if any specific, you see a lot of traction happening in nuclear energy in US. US, the government has given a $1.52 billion loan to restart the nuclear capacity. India has asked for $5 billion of loan from various institutions outside, to develop a nuclear energy capacity. So nuclear energy is something which will, gain traction, because it's one of the cleanest form of energy, and China has already mastered it. China has or have been going across the countries, telling them that we will set up nuclear energy facilities for you, and in return, what China does demand. So they have been going berserk, developing infrastructure across the globe, in South Africa, in Sri Lanka, creating a trade route. So we as an economy are also countering by developing the road and belt initiatives. So that's the reason I'm telling you $7 trillion invested in manufacturing, infra, real estate, and nuclear energy is where China is right now, and China is always way ahead of us. So we'll definitely require huge amount of investments. So to compete with China, we will need extremely focused strategies and policies and large investments in physical assets for a very, very long time. So then we could, basically see ourselves at, number two economy maybe by 2047. So that's a chart which is showing that China has the highest investment share of any major economy, where it is investing 42% of the GDP. India is investing 30%. South Korea definitely is investing 30 to close to 29%. Indonesia, Turkey, Russia, and the world. So we are above average of what world is investing. So yes. So drawing the curtains, I would basically tell one instances where what we feel and where the market is heading. So during uncertainties, right? So it's very clear that people rush and buy gold. Okay, and it's very, very fair that gold has an intrinsic value. So, but there's really amazing happening, or maybe really amazing less noticed story which is emerging in metals. So gold has an intrinsic value, but metals are gold to their fundamental. So where the metals are used, such as zinc, aluminum, silver, copper, will continue to do well because they are gold to their fundamental usage. So if I were to tell you that the demand of EV with solar panels, solar PV panels, with semiconductor demand is going berserk upside. So these rich minerals are basically going to see a huge influx of demand. Zinc, aluminum, silver, copper will continue to do well. So that's some really amazing, less noticed story which is emerging in the metals, which is, people are not realizing. And when it comes to copper, China has an overcapacity, and you would see demand of copper bouncing back in the month of June, July. There would be a bit of escalations against Taiwan developing during that time, because from July to November, US is getting into elections. There'll be debate happening, so China will, pretty much try to distract from that point of view. So Asian economies are definitely industrializing, as I told you, and they have added us. They have also have strong domestic consumption. China will and has always continued to do well, would rather disrupt a few industries. Nuclear, as I mentioned, that they have the nuclear capacities. EVs, yeah. So China EV quality and that the manufacturing cost is what the manufacturing cost of Chinese EV is one third less of what US is. So, matlab, if my cost of making EV is 100 rupees, and the Chinese manufacture EVs at probably 50, 60 rupees. So even they could bring those costs down. They have not yet bought. So that's the reason US fears that there would be excessive oversupply of EVs in the economy, US or maybe Europe, which is major consumption of Chinese exports. So that's the reason they, basically get with tariff wars, trade wars. So China will disrupt few industries, EV and nuclear to be very precise. As I mentioned, US is heavily industrializing. One third of their construction spends are, very much allocated to factory spend. There's one point: consumption of electricity is going up. If I have to tell you that data centers are booming, okay, AI is booming, okay, with generative AI is booming, which consumes 25 times of electricity what Google does, okay, with electric vehicles booming, okay, and with investments in solar panels are booming. Where is the electricity going to come from? There's demand of electricity which will go berserk. There will be new grid facilities which will be in the system. There will be transformers, so those companies will do really good. Africa is something which is unnoticed, and it's going to be the next global hub, attracting major flows. You see rental yields in Africa. The retail yields are trading at 8 to 9%, and the commercial yields are trading at 15%. China is developing a huge infra over there. India real estate companies are developing housing buildings over there. So America, Africa is the next big hub which we are expecting. Latin America would definitely attract huge inflows due to high interest rates, and they definitely have an added advantage over there. But I don't, yeah, so that's one thing. And uh, drawing the curtains, what we feel which sectors would do really good. Capital goods sectors has always outperformed in the last capex cycle, which is 2003 2008, and we could see that cycle repeating. And sectors to watch would be industrial sectors is one specific aspect which we think that's very positive, because with policy continuity, the earning estimates would reject, and what was expensive then would seem cheap right now. And always historically in India, there's always one thing which has happened. If I have to tell you that the private capex is driven majorly by the government capex. So government comes out, places order, forces the private people to increase their capacities and accept the orders. So the government capex is seeping in the private capex, and you will see that percentage increasing going forward. Private capex is going to play a huge role lifting the economies at the later stages. So industrials, capital goods, engineering is going to do really good. Healthcare is a sector which is unnoticed right now. Specifically, generic pharmaceuticals and diagnostics would do really good because we have become affluent not only in terms of our purchases but also in terms of our health. So that's something which is something to be watched for. Banking is trading at fair valuations, and private banks have seen a fair amount of outflows. So that's one aspect. But we are trading at 3.5 price to book valuation. So it's fair. So banking would do really good because banking has to grow 16-17% for the economy to touch X trillion dollars. So that's one aspect. So what I feel, and also there's always a risk in investing. We talk कि कौन सा right time है, कौन सा right time है to buy or right time है to sell, rather than timing the markets. The biggest risk of this era is not being invested than being invested. So markets are here to perform. 2010 to 2020s markets were totally flat. FDs के returns को beat नहीं कर पाए हम. So 2020s to 2030s and 40s is where I feel that the way markets are moving, or maybe if I have to talk or highlight you in terms of earnings and multiples. So the markets, as I told you during the start, has been trading at a very narrow right. So maybe Sensex or Nifty, Sensex trading at 72 to 74, 75,000 is a range of 4.5%. So if at all it trades at that range, Sensex or Nifty, you will see the price to earning fall, the valuation fall by 8 to 9%, and with respect to Asia x Japan would come down from currently 50% to 30 to 40%, and that's a fair amount of valuation. And there's one analysis also which we had done. We had posted on our company website that from 2018-19 and until now, the major rally which was driven was earnings driven. The price to earning expansion or regic has not happened yet. It was all earnings driven rally. So you could go specifically check that report out in our company blog. So if at all there's a P regic happening, so maybe we are right now not at a favorable interest rates. We are at 6.5%. So maybe if interest rates fall, private capex picks up, or maybe investments picks up. So you will see P multiple regic happening. So if earnings are going up and P regic is also happening, so you will see price indirectly moving, right, at the end of the day. So price is equal to what? The formula is way too simple. A price is equal to P into EPS, right? So अगर दोनों ऊपर उठेगा तो price तो definitely ऊपर उठना ही है. So right now only the earnings are going up, and the P is very consistent. It has been very flat, and the price, whatever rally which we have seen in Nifty is driven by earnings. But if the regic happens in the P multiples, probably we are trading at 20 or 21. So with valuation correction, we'll see the P is coming back to 19 for 520. And what I feel that 22, 23 something multiple would happen in the next 2, 3 years, where we would see Nifty at 26, 27,000. So this is what we feel about the markets. And I would again quote that the risk right now is of not staying invested than staying invested. So listen to the government policies, what the governments are talking about, which sectors are they targeting, and prioritize your portfolios accordingly, because that's how you're going to make money. So yes, I would try ending the session over here. So majorly we have covered the change of the global landscape from US to China, the depreciate, the dollar supply is going berserk, which would lead to fall in its value. Chinese have started dealing with the local trades in their own currency, and China has also given, if I'm a major exporter to China, right? So I'm paid in renminbi. So I can go to the Hong Kong exchange and exchange that currency with gold. So it's fine. That's the reason. That's another reason the gold prices are driving. So US fears that they're going to lose dominance. And there's also one major highlight, and this is out of context, and we're not trying to connect this with of our PPT with BlackRock into picture. So we have seen BlackRock hitting $10 trillion in asset, right? So it is basically majorly an interesting aspect of our analysis. I would tell that if I have to connect dots, Ukraine and Russia war, US was, pretty much aiding Ukraine, right? In terms of military aid, in terms of, restructuring the infrastructure. So military aid was around $125 billion. It is not that $125 billion were given to Ukraine. It were given to a defense manufacturing company in US that is owned by BlackRock, right? And that's how US is playing smart. Also, US has sanctioned $60 billion of aid in infra development to Ukraine, and US aids do come at a cost, and the cost over there is the agricultural lands. Ukraine is rich for its agricultural land, and 1/3 of agricultural land have been already pledged to the companies in US, which is owned by BlackRock. So at the end of the day, you see, when we talk on BlackRock growing their assets, so there's always government support, there's always government involvement over there. So how do we not come to know about this? Just because the global politics is dirty, people don't want us to focus on all this. That's the reason they go waging war, and the only one person who's impacted are the retail investors and the soldiers who are at the border front. So rest, everyone stands to win. So rather than focusing on all the chaos or what's happening, what's not happening, try structuring our portfolio, be a long-term investor, and I'm sure the rewards are in for it. Thank you, and I would like to end the session from you. So सेशन एंड कर सकते हैं.